Hello and welcome to this week's fund review. Today we're going to take a look at Dodge & Cox International stock. We arrived at this fund because in our Facebook group each Tuesday we post a poll. We take the list of the top 10 mutual funds by asset size in a particular category, and then we let the members of the group vote on which fund they'd like to see us take a little bit deeper dive into. So by a narrow margin, this week, Dodge & Cox International stock was the overall winner. So if you're watching this on YouTube, be sure to join our Facebook group, 401k and Beyond. That way you'll have access to these videos. Also, we do Fiduciary Friday, where we take a look at somebody's retirement plan, break that down. And there's additional content throughout the week that we post. And obviously, members can post their questions based on their retirement plan or investments, or any other sort of financial wellness topic. So before we get into this particular fund itself, I have to take a couple minutes and talk about Dodge & Cox as an organization. So it may not be a household name like Vanguard or T. Rowe or Fidelity, but for those folks in the investment business, we're very familiar with Dodge & Cox. They're not a fund family who's going to come out with a new fund every few months. They're not going to come out with a new fund based on the hottest sector or asset class. Even though they've been around 90 years, they still have just a 6 strategy. So you've got 3 equity funds, 2 fixed income funds, and then they bring it all together with Dodge & Cox Balanced. So when you look at the 9 style boxes, they work the same internationally as they do domestically, right? So on the top, you have your large cap, followed by mid cap and small cap at the bottom. On the left side of the box is value. So those are mutual funds who are looking to find undervalued stocks relative to the market. On the far right is going to be your growth sector. So looking for stocks and looking for funds here who are expected to outperform the market. And then down the middle, of course, is the blend. So in the top left is foreign large value. Dodge & Cox is going to be benchmarked against the MSCI EAFE, which stands for Europe, Asia, Australia, and the Far East. This index includes can include different size market caps from those different countries and those different areas. It is primarily a developed market index, so you won't find a lot of emerging markets in the index itself. A reminder that this video is just general education. Nothing shared in this video should be considered specific tax, legal, or investment advice, and certainly don't act on any information in this video or this group without first consulting your tax, legal, or investment advisor. We are an independent investment advisory firm but have no affiliation to the reviewed fund. We may or may not have a position in this fund with our own assets or client assets. So this fund, even though it's been around 20 years, is actually one of the newer funds in the Dodge & Cox lineup. $43 billion, just under spread among 90 holdings. Diana's been there through the whole time. And what's important about Dodge & Cox stock is they do a really good job with their bench or their farm system or however you want to say it. But they do a good job in recruiting and retaining portfolio managers, and they bring them up through the ranks, and they have their committees. And what they're trying to avoid here is that star manager approach, right? So you hear that from some other firms, maybe not as much as you did a few years ago, but you'd have those rock star stock pickers and that sort of stuff. And then there'd always be that key person risk, right? What happened when that person aged out of the position, or something happened to them, or if they bolted to another firm, which has happened before. But even though they have really good talent at Dodge & Cox, you get the feeling that there's never that one person that they couldn't do without, because they have such a strong management team here. So that goes into what we call an actively managed fund. You compare that to the other side of the spectrum, which is considered a passive or index fund. For a passive and index fund, you're basically following stocks that are on a list, right? Like the Dow Jones Industrial Average, which is 30 stocks, or the S&P 500. An actively managed fund like Dodge & Cox International is picking stocks, investing in companies that they think will outperform the index. So what's interesting about funds on the international side is they have a few more levers to pull, so to speak. So if you think about domestically, how can somebody in the large cap growth style box, how can they outperform others in the large cap growth? Well, they could dip down into mid cap growth a little bit. They could move over into blend or to value. They could overweight or underweight particular stocks or sectors. And you can do all of that on the international side, but you can also make a decision to hedge or not hedge your currency. You can also overweight a particular continent or underweight a continent. Even a particular country, you may decide as a fund to overweight Japan and underweight Australia, so to speak. So there are some different levers to pull here, and certainly you've got a wide array of stocks to choose from. But this is most certainly actively managed fund, and we'll show that throughout the presentation. One thing you obviously want to look at if you're an international stock fund, do they have most of their investments outside of the US, which they do here, over 90%. The other thing that's important here is that cash position. So, 2% in cash, which is, about what you'd expect here. That 2% cash position is designed to help them with flows. Money flowing in goes into the cash position. If they have to process redemptions, that's coming out of that cash position. So they're not necessarily making a market call there, right? You're not going to see that cash position jump to 25% because they've decided to, get out of the market, so to speak. It's just simply there to maintain that balance to help with flows. When you look at the stocks that they've owned these stocks for a while. There's not a lot of turnover here. Your turnover is less than 20% of the portfolio. So even though it's an actively managed fund, they're making their investments and they're sticking with them. Of their top 10 investments that you're looking here, their most recent purchase was Samsung, and they bought that in 2018. So you're looking at minimum 3-year holding just on of the top 10 holdings here. So again, they don't have a huge weighting. There's nothing here over, just barely over 3.5%, but they're top holdings. Even though, they got about 70 holdings in here from an equity standpoint, that might be considered concentrated as far as the number of stocks, but it's certainly not a large position in the top 10. So there's not a huge single stock risk with this portfolio. We want to look at fees and the expense ratios as compared to the category. And that's really the best way to benchmark fees, right? Somebody looking at this maybe with a not as much of a trained eye might say, well, I see index funds at 1, 2, 3, 4 basis points. 63 basis points looks really expensive. You're going to see international stock funds be more expensive because there's a lot of times they have to travel overseas. Obviously, they may even have offices on different continents or employ people in those areas. So that can be an added expense to the portfolio. So with that, though, you want to compare it to everybody else in its category, which is that foreign large value. So 63 basis points for this fund, which translates into $6.30 for every $1,000 invested, is still significantly less than the category average, which is nearly 1%, or about $9.50 for every $1,000 invested. And with every expense ratio, you want to take a look and say, okay, what am I paying for? If I could get that index fund at 10 basis points, why would I pay, in the 60s for that? Well, you want to get outperformance. You want to get outperformance against the category, and you want to get outperformance against that benchmark. So this is a fund that has outperformed its category 7 out of the last 10 years, 4 out of the last 5, as you can see. And even in 2018, it really didn't underperform by that much. 2015 was the biggest year of underperformance, and the category was down, and Dodge & Cox International was down significantly more than the category, but for the most part, they have outperformed. Similar things you see when you're looking at the index. So outperformed 6 out of the last 10 years, and they're really in the ballpark most years. You're not going to see a lot of huge variance from the index. You will see a little bit more because they do have a little bit of emerging market exposure where the index doesn't. So that can add some additional volatility to the portfolio. Overall, I give this fund a B+ grade. The return, I give a B+. They've done a good job producing those returns against the benchmark and against the category. Dodge & Cox, as a firm, I give an A just because of their strategic way that they bring managers through the system. The risk, I do give it a little bit of a B because, like we talked about before, it does have that emerging market exposure. So, we talk about these funds and we think about, okay, how do I position this fund? If I want to own this fund, how do I sort of build around this? So if you think of this fund going back to the style boxes, this is in the foreign large value. So you want to balance that out with a foreign large growth potentially. And then you want to look at the two of those and how they cross over. The other thing you want to take a look at here is is that in is that emerging market exposure. So whereas you might say I want an emerging market fund to be maybe 5 to 7% of my portfolio, I'm going to scale it back because there is some of that inside of this fund here. A reminder that about this video only providing general education, not any specific tax, legal, or investment advice. Don't act on anything in this video without first consulting that tax, legal, or investment advisor. For additional resources, be sure to look at dodgeandcox.com. You want to always go back to that, source document. And Dodge and Cox puts out some great materials as far as their quarterly reviews, of course, annual reviews. You can pull those right off the Dodge and Cox website. And of course, we always talk about Morningstar.com. They have a lot of free information that's available there that's ad supported. They also have some different, premium packages where you can go on and get some additional data about Dodge and Cox or any other fund. Yeah, and I want to thank anybody who's watching this video in our Facebook group. Thanks for voting and selecting this fund. Be sure to check out some additional videos on the YouTube channel. If you are watching this on YouTube channel, we encourage you to join the 401k Beyond group in Facebook. We continue to grow that group, add new members each week, and have some pretty interesting discussions there. You could always upload some information to me and we could spotlight your company retirement plan. We can take a look under the hood and see what's going on there based on the 5500 information and anything you supply. So again, this is Brian Williams from Northshire Consulting, which is an independent investment advisory firm. We're open to some feedback, so you can send that along to us or post it below in the comments. Thank you.